This is really good because it helps you in your taxes. It also protects you from volatility and liquidity.
Yeah.
Those would be like really the three big things if I'm listening to you properly.
Yeah, I mean, we talk about I got a whole chapter in my book. I've got a book on Amazon called Be the Bank,
Yeah.
and it talks about this concept and what we're talking about today. We look at 4 wealth destroyers that really destroy people's wealth, and that's taxes, fees, volatility, and spending.
All right, Darren Mitchell, we are live, brother. How you doing?
I'm doing fantastic.
Awesome. Good to see you in person again. I've seen you do your talk at a few different events, and you do such a great job at it. Like I really enjoy hearing what you've got to say, and you do it in such a great layman's term because it's a bit of a complex, program.
Yeah, I think what I was lucky enough to identify at an early age my unique ability, and it's to take something fairly complicated and explain it in an easy to understand fashion. And I always say, if you can't explain it on one page, you don't understand it well enough to be teaching it to someone else.
I get that 100%. So before we dive into, because we're talking about infinite banking today, before we dive into it, why don't you let everybody know who doesn't know you, what you do, what it's all about, and why you even got into this particular strategy?
Sure. So Darren Mitchell, our company is Control and Compound Financial,
Yeah.
and we work coast to coast across the country, and we help predominantly real estate investors, business owners, or individuals that want to get into one of those fields, control their money to enable them to take advantage of real estate and business opportunities, to grow their money tax free, access their money tax free, and retire really in a. My goal is for my kids to retire in a tax or zero tax environment. So people don't look at what's eroding their wealth. They look at the latest, greatest, or they follow the herd. Wealthy people don't follow the herd.
Yeah, absolutely. Now, here's a big question, because for me, I came from the corporate world. I realized that traditional financial planning wasn't working for me. I was making more money every single year. I was climbing that ladder, but it always felt like I was going backwards. Snakes and ladders.
Yeah.
Like it just felt like I kept sliding down, like I kept rolling the wrong dice on landing on the wrong part of the board. And so how has traditional financing let, we'll say, real estate investors down, business owners down, and also we'll say the middle class as well, too, because I do believe it has.
Yeah. So for me, the big aha moment was 2008 when the market crashed. I was salmon fishing in Alaska, and the market's crashing, and every hour I'm trying to check on the markets to see what they're doing. And I was a traditional financial planning then, right? I do mutual funds and RSPs and all that stuff. And I just felt like I was out of control, wasn't in control of my money. And then I realized, well, I'm not in control of my clients' money. And I was in my 30s, no big deal. But
right.
People in their 40s, 50s, 60s, 70s, and 80s like to be out of control. So I kind of started studying what the wealthy people are doing. And the wealthy people aren't doing what everyone else is doing, right? If you get 90% of the wealth is tied up in 10% of the hands, but yet the strategies most people follow are for the 90% of people follow the strategies that only have 10% of the wealth. So when I started studying the wealthy, there's really 3 things I think you need to do to become wealthy. And this is, you think of every wealthy person you've met, and I bet you they're going to hit one of these things.
Yep.
Number 1, you invest in yourself. You're the greatest asset. Anything you can do to make yourself better. Take a course, get some education, get a coach, join a real estate group, join an entrepreneur group. So number 1, invest in yourself. Number 2, start a business. And number 3, get into real estate or some other fixed asset. So if that's where you're going to make your money, that I could really call that step 2. Step 1 is, where are you going to save or store your wealth? So back to your traditional financial planning. If you put money in an RSP and you're 20 years old, like to say to a 30-year-old entrepreneur, real estate investor, what I think you should do is give up control of your money, put it in a nice balanced mutual fund at the bank, in an RSP, put it there for the next 40 years, cross your fingers, hope everything works out, and then hopefully there'll be enough for you to get by every month, and then we'll drip it back to you for the 30 years in retirement, a little bit each month. I think that's just crazy. If if your goal is to invest in yourself, business, and real estate, you've got to be in control of your money. So step number one for me is, how do you stay in control of your money? And that led me really to this infinite banking concept.
Now, how long has infinite banking been around? Because at least for me, it feels like it's a new concept, but this thing's been around for a long time, hasn't it?
Yeah, I mean, the product we use is this specially designed participating high cash value life insurance. That's been around since 1846. So the concept's been around since 1846.
Yeah.
We use 4 companies, and the newest company we use has a 100-year track record. And all of these 4 companies have paid a dividend each and every year for 100 plus years. Never missed a year. World War I, World War II, COVID, you name it. Anything that happened in the last 100 years, they always paid a dividend. The infinite banking concept really became popular probably in the 80s. Nelson Nash down in Birmingham, Alabama, wrote a book, and he was promoting it, becoming your own banker. So that was really in the States. The concept was around, but no one really just put a phrase to it, and the infinite banking kind of stuck. And people always say, well, is it an American thing? And I'm like, well, we can do it in Canada. And the difference of Canada and the US is it's better here, I think, because you save money it's a completely tax-free growth, tax-free loans, tax-free death benefit, and our taxes are higher. So if you're going to be saving taxes, you're going to save more in Canada than you are in the States. So to answer your question, it's been around 100 plus years, or at least since the 1980s, the term's been around.
Okay, so let's dive into it. Let's actually break this thing down. How does it work? Why would I even want to get into infinite banking, and who is it really good for?
Sure. So if we think of it back to that, you being in control, I think of it like a pyramid, right? Like the base of your house, the foundation of your home is the most important part.
Right.
Without a strong foundation, it crumbles.
Yep.
Well, the base of your financial plan should be the exact same. It's got to be rock solid and bulletproof. And that's really cash or cash value life insurance. And that's the product we use for the infinite banking concept, cash value life insurance.
Okay. Now, does it matter if it's universal or whole life? Is it?
Absolutely.
Okay.
We could have a whole podcast on that, but I'll give you the Coles notes, Cliff's notes, or for those young people, the summary. Universal life, bad; whole life, good. Okay. When it comes to the infinite banking concept, we really can't do most of the things we want to do with the infinite banking concept with the universal life. So we need a participating whole life, but it's going to be focused on the cash value. So two components, cash and death benefit. We're just focused on the cash, number one. So we're trying to drive up that cash. So we say, okay, let's save some money in this cash value life insurance. It's guaranteed to go up every year, can't go backwards. So fast forward a couple of years and an opportunity comes along. Maybe the stock market's down 40%. Maybe real estate's down 20%. Those are when the opportunities come along. So now when you're ready for that opportunity, we want to leave our money in the policy and allow it to grow tax-free for the rest of our life. Never going to touch that. But that policy gives us the right to borrow 90% of our cash value, no questions asked.
Right.
So if we have $100,000 in there.
So up to 90%.
Up to 90%.
Okay. And this is where we're talking now loan to value for anybody who's listening, right? Yep. So if you've got 500,000 in there, then you could go up to, what would that be?
450.
450. Yeah.
Yep.
Okay.
So when you go to apply for that loan, they ask you 2 questions before they give you the money.
Okay.
They say, all right, Gary, would you like a check or would you like it deposited in your bank account? That's it. There's no financials. They don't ask you when you're going to pay it back, how you're going to pay it back, if you're going to pay it back. There's no requirement for you to make a payment. You pay it back when, how, and if you want. Now, we encourage you to pay it back in the early years so you can use it over and over again. We can talk later about what you do in retirement, how you never pay it back. So I go to my control and compound office or the insurance company and say, hey, I'd like to borrow 90% of the cash value. I take that out. Now, as a real estate investor, that doesn't show up on my credit report. So you can actually use that for a down payment and then go and get your mortgage. So now your money's in the policy, compounding tax-free, and it's providing a death benefit, and you're in this real estate opportunity. So really, we've multiplied money just like banks do every single day. So our money is in more than one place. So we call it the and asset. Every other asset you have is an or asset. Do I do real estate or my business or the stock market or Bitcoin? This is an and asset. We're going to put it in the cash value life insurance policy. We're going to compound it for the rest of your life tax-free for a tax-free retirement. But all along the way, we're going to multiply that money for these and opportunities.
Okay, so the money goes in there. It's being invested. Can I choose what it's invested in, or is it being selected for me? Like, is it like almost like a mutual fund, or like how does that work?
It's professionally managed money by the insurance company. Now, it's again guaranteed to go up, 150-year track record of paying a dividend. So it's fairly conservative what they do. But if you think of the advantage that we have in the whole life fund, so I'll give you the kind of quick version of what they invest in. They're going to invest in bonds. They're going to provide mortgages. They have mortgages. They invest in real estate. They have a little bit into the stock market. And then they do a lot of private lending, except, $13-20 billion funds. They're doing things like the 407 toll highway, the bridge to PEI, some major infrastructure projects. But two things about those investments. They look at a guy like you, Gary, and they go, all right, he's a healthy guy. He's probably going to live another 50, 60, 70, 80 years. So we don't have to pay that death claim for a long time. So we can invest that money long term, but we can also invest that money tax-free because it's inside the insurance policy. So if you look at the difference of taxable versus tax-free in the long term, it's just night and day. So that's how they're able to get these consistent returns forever and ever and ever. So that money grows.
Right. Now, can we talk about like what type of returns are we looking for? Are we looking at, is it 3% annually, or is it more like, say, 5 to 7%?
Sure. So the way these policies start is, I think of it like a renovation. Year one in a renovation, you're underwater, right? You're losing money. It's not a get rich quick scheme in a renovation. You're going to buy it. You're going to do BRRRR. You're going to do flip to yourself, whatever you're going to do. You're going to put the money in. You're going to be underwater for a couple years. Eventually, you're going to be wealthy. And the infinite banking concept's the same. So you put money in year one, you're going to have less access to cash than if you just kept it in the bank. But by year 2 or 3, now you're going to start compounding more than what you put it in. Long term, the cash right now, somewhere between 5 and 6%, but it's tax free. So that would have to be like a 10% return in a GIC to get that. So the dividends, all the dividends for the 4 companies we use are 6.5%.
Okay.
And of that dividend, most of it we can drive towards the cash value. A little bit will go towards the death benefit, and the death benefit will increase each and every year till death.
Got it. Now, the beautiful thing that I love about this is that the fact that you're putting your money in there, and then you can also take it out, but you're not actually taking the money out. It's being lent to you. But now, what banks will loan to you, and is it difficult to get that money out?
Yeah. It's contractual that they have to loan you 90%, no questions asked. So the loan actually comes from the insurance company. So the insurance company says, great, if you have 100 grand, whatever you have in your policy, we contractually will loan you 90% of that. And if you think of why in real estate are they loaning 70, 75, 80%? Well, there's a risk that piece of real estate could go down in value. There's a risk that, there could be a fire. The tenants aren't going to pay and it's going to blow up. Well, if you think of the risk here for the insurance company loaning you 90%, the money's guaranteed to go up every year. And in the event that you die, there's going to be this big death benefit. So if you borrow $90,000 and you get hit by a bus, next month, they're going to pay your family $500,000 death benefit or whatever the death benefit is. And they're just going to say, hey, we're going to subtract the $90,000 that the owner borrowed, and we're going to give the family $410,000. So the insurance company's protected. So that's why they'll give you an up to 90% loan and no requirement. You can capitalize the interest. So if I'm doing a short term next couple of years, I'm not going to pay the interest if I know I have an event that's going to be able to pay it back. If I'm borrowing more for the long term, I'll pay the interest or maybe even pay some of the capital or some of the balance off each month.
Right. Okay. Now we also talked about the interest that I have to pay on a monthly basis if I pull that money out. I assume that is going to be higher than what I'm making. So if it's 6%, let's say that's the return, we'll use that number.
Yep.
And if I'm going to get that loan to go buy another asset or take a vacation, I'm sure I can do that as well too. Yep. I don't recommend it, but if you go buy an asset, what would be the interest payment on that typically?
Okay. Yeah. So let's talk about that loan. It's really, really, really important. So the interest is tax deductible if you use it for an investment, real estate, business opportunity. You can pay it back when, how, and if you want, and it's unstructured. So again, you pay it back as you want. The interest rate today is somewhere between 6.5 and 8.5, depending upon the company. And the cash is growing at 5 or 6%. But the interest is tax deductible, so you start doing that math. But more importantly, we had a huge spike in interest rates. Mm-hmm. So historically, the dividend or what your cash is going to grow is equal to or greater than the loan. If we had talked 2 years ago, the loan was 4.45, 4.7 in that range, and the cash was still growing at 5% plus. So when interest rates spike, typically what happens is because the whole life investments tend to be interest rate sensitive, mortgages, private lending, bonds. Well, when interest rates spike, the whole life dividend will increase a little slower than the interest rates because, they could have outstanding 5-year mortgages now at 2.5%. Well, they can't cancel those mortgages to people they loan money to. But when those mortgages come due, they'll increase. So historically, you're going to be around the same. Right now, with that spike in interest rates, we're slightly higher on the loan. But like people get hung up on the interest on the loan. And I'll tell a quick story. I was down in Florida years ago, and this accountant was speaking, and he said, all my clients are business owners. And he talked about 2008, and he said, my clients that had access to money are significantly wealthier than all my other clients. And he told a story about how a guy borrowed $1 million from his cash value life insurance policy and was able to buy 13 additional franchises for the franchise he was in at 30 cents on the dollar. And he goes, he 10x'd his wealth in 4 years. And then someone raises their hand and goes, what was the interest rate on that loan? And the accountant's like, who gives a crap? The man 10x'd his income because he had access to money when no one else could. So for me, that control of your money is so much more important than whether the interest rate's 4, 6, or 8%. And again, it's tax deductible. Typically, short-term loans we're looking at less than 5 years. So the difference between 6 and 8% really doesn't matter.
I understand that. And the reason being is I was on that side before as well, where you're taught not to put yourself in debt. And you're not taught the difference between good debt and bad debt. Yeah. And I think a lot of people group debt as debt. But if you understand having access to money, or debt, and you can take that 6 or 7% interest payment, but you can make 10, 12, 20, 30% on that money, that's free money. Yeah. And I think that's where people get hung up on, or they're just not educated. And I think that's what we started off with, saying that, the financial planning piece of it, it's failed people. Maybe they just don't understand it, or they're not learning from people who are where they want to be. And I think that's the big issue.
Yeah. I mean, people come to me and they say, well, I can get a higher interest rate or like a higher return somewhere else. And I'm like, great, let's do the policy and that. So now you have a tax-free in the policy, plus you have your 15% private lending or 20% real estate or whatever you're doing. You're paying some little interest that you write off, and now you have your money in two places at the same time growing instead of one. And again, this is what the wealthy are doing. Like over $1.2 billion a year goes into these policies a year in Canada. Right. Like this isn't, they've been around 100 plus years. This isn't the latest, greatest get rich. This has been tried, proven, consistent for 100 plus years in Canada.
Now, what about, I do have real estate agents that will listen to this, or even business owners. What about if you have a corporation or a PREC? Can you put that money in there?
Yeah. I mean, this works incredibly well personally. But if you have a CCPC, a PREC, or like an operating business, not just a holding company like for real estate, but if you have an operating business, like in Ontario, your first $500,000 you earn in that corporation, you pay roughly 12% tax. Yep. So we call those, if you earn $1, you pay 12% tax. So we call those 88-cent dollars. Mm-hmm. So you take a business owner and you go, okay, you have $100,000 at the end of the year that you don't need to put back in your company. You've paid your bills. What do you do with that? Well, you could pay that out to yourself as a salary or bonus and be left with roughly $50,000 or 50 cents on the dollar. Or you could leave that money inside your corporation and be left with $88,000. So a lot of business owners keep money in their corp and say, oh, this is cool. Now I have $88,000 instead of $50,000. The problem for business owners with money inside your corporation or a PREC is when you invest that money, you're going to pay taxes on the growth. You're going to pay taxes when you go to get that money out, to spend it. You're going to pay taxes on that if you die. You're now going to pay 67% capital gains inclusion on any capital investment you make. And for those that are earning a little more money in there, once you cross $50,000 a year of passive income in your corporation, they are going to absolutely just hammer you with taxes, and you're going to lose some of that small business 12% tax. We take those 88-cent dollars or 88,000 in my example, we can take that full 88,000 and put that right into the insurance policy. So as a business owner, you've kind of have like a 76% return day one because you're investing 88,000 instead of 50,000 in my example. So as a business owner, what this enabled me to do is I found I was hesitant to save money as a business owner because I didn't want to put money in an RSP because what if I needed it and business was slow in 6 months, or what if an opportunity came along? So I tended to hoard a lot of cash, and then money in your bank account tends to be spent. But now I put my money in an infinite banking type policy, cash value life insurance policy. That money's going to be there for the long term, grow tax-free for the rest of my life for a tax-free income. But if a great opportunity comes along in 6, 12, 18, 3 years, or an emergency comes along or I need to make payroll, I can borrow 90% of my cash value, pay that emergency, or take advantage of that opportunity. So it's giving me the freedom to grow that money long-term as well as use it short-term, versus before it was either sitting in a bank account doing nothing or in an RSP in prison.
Right. I love that. And so then, this is really good because it helps you in your taxes. It also protects you from volatility and liquidity.
Yeah.
Those would be like really the three big things if I'm listening to you properly.
Yeah. I mean, we talk about, I got a whole chapter in my book. I've got a book on Amazon called Be the Bank.
Yeah.
And it talks about this concept and what we're talking about today. We look at 4 wealth destroyers that really destroy people's wealth. And that's taxes, fees, volatility, and spending. So taxes is pretty obvious, right? We're going to grow tax-free. You're going to be able to access the loans tax-free. And when you die, it's tax-free. Even your corporate money is going to be tax-free in retirement and tax-free at death. So taxes, fees. The fees on this, the average mutual fund is still around 2.2% in Canada, which is crazy management expense ratio.
Right.
The average fee here, these 4 plans that we use, they're actually federally regulated, that the government says you can only charge so much to manage this fee. So the fees are like 0.13 or so is the
Really?
average. So incredibly low fee.
Okay.
So we got taxes, fees, volatility, never went down, guaranteed to go up, 150-year track record. These are not volatile at all. So when those opportunities arrive, when the markets crash, you're guaranteed not to go down. And finally, spending, the other thing that interrupts people's wealth is, they save, and then an opportunity or expense comes along and they cash out that investment and go right back to zero, and they got to restart the compounding. With the wealthy, I studied, they never stop the compounding. And this is a policy that allows you to do that, grow forever and ever. And to your point of liquidity, you have ultimate liquidity because now if an emergency or an opportunity comes along, I know where I can access money. So it's my emergency fund, but I like to call it even better, it's my opportunity fund. And people say, well, how much do I have to put in? I'm like, we don't have to put in anything, but how big of an opportunity do you want to take advantage of? How big of a tax-free retirement do you want? How much do you want a death benefit to be so the properties can stay with your family instead of being sold to pay the tax bill down the road? So it's perfect for real estate investors, business owners, those that want to get into that, or just regular middle-class people.
Right. Now, I think I was reading on one of your blogs, Dave Ramsey. He was not a big fan of this, but you also highlighted it, so there's probably a reason why you did. You want to touch on that?
Sure. So Dave Ramsey talks a lot about a lot of things. I still have not seen his guarantee or his 12% mutual fund each and every year without a negative year. So a couple of things I push back on Dave Ramsey is, I believe if there's 10,000 insurance products in Canada,
Yep.
there's only 4 that we use for this. So I'm not going to argue that you shouldn't be putting money into insurance versus an investment. But for these 4 products, I'll push back because to me, giving ultimate control of your money. And Dave talks a lot about, I always joke, I go, I don't have a lot of teacher clients, right? I've got one teacher client and I had to marry her. So, she's a great client. I don't know how she somehow comes up with huge premiums every year, but if your thing is you're a T4 employee and you want to put a couple hundred bucks extra and you want to pay down some debt, Dave Ramsey's your guy. If you're someone that acknowledges where you're going to make true wealth is not in the stock market, in mutual funds, but true wealth is going to come from investing in yourself, business, and real estate, then we're your guy. So, people come to us all the time and say, I think this is for me. And we talk to them and we say, you know what, this isn't for you. The traditional financial planning, paying off those debts, doing that. Where I find the insurance industry as a whole really does itself a disservice is I'll meet with a client and they're like, oh, I have one of these policies, and I'll look at them and it's maybe someone with 3 little kids and a stay-at-home spouse, and they're putting $300 or $400 or $500 into this policy, and I'm like, this is like malpractice. I go, you have a death benefit of $200,000, and if you die, your family is going to be in dire straits. That person should have had maybe $1, $2, $3 million of cheap term insurance that if something happened. So those are the people that Dave Ramsey really attacks, is when people put this policy in place when it shouldn't be put in place for that person. Because if you're not able to save $500 or $1,000 a month or sitting on a lump sum, I don't believe this infinite banking concept is for you. There's a lot in my industry that, I met a guy once in, it was one of the events I met you at Danielle's event.
Yeah.
And this guy came to me and he goes, I have 47 policy loans. And I'm like, yeah, you're never going to be a client of ours, because people are like, yeah, you can borrow it for vacations. You can borrow it to buy groceries. You can borrow. And I'm like, if you're borrowing to buy groceries, you shouldn't be doing this. We believe you should only borrow for opportunities and emergencies. So I think that's part of the Dave Ramsey thing is we have some people out there that are selling this to inappropriate time in someone's life, or just selling it when it shouldn't be sold to that individual at all.
Right. So the audience that Dave Ramsey is talking about is the audience that you just mentioned there, where they're in their 9 to 5, they don't have any additional assets. They're not, they're maybe middle class, lower middle class, and they don't have a lot of opportunities that they're chasing. They're just like, hey, I'm doing my thing, leave me alone. I'll get a term life policy, and that's it.
Yeah, I'm going to do term life, and I'm going to do RSPs or 401k in the States, and say, I don't care, I'm locking my money up for life because I'm not planning on taking advantage of an opportunity. But back to your middle class, if you're middle class and you say, I would like to be able to take advantage of an opportunity to perhaps start my own business someday, perhaps get into the real estate game, some real estate investing game someday, well, then I would say, yes, this is for you. But if your goal is to just work Monday to Friday for the rest of your life, collect a pension, and you want to save some more money, great. Pay off your debt, put your money in a mutual fund like Dave Ramsey says, that's great. But if you're a business owner, entrepreneur, or real estate investor or entrepreneur, or someone who wants to take advantage of opportunities down the road, then those are the people we like to talk to.
Okay. Now, if somebody's listening to this and they're like, okay, cool, I'm liking this concept. I've heard this from a friend or heard this someplace else. How do they know if they're talking to the right, is it called dealer?
Yeah.
Right.
So we would say advisor or agent,
okay.
or I struggle with this one because this, even if I meet so many people that have a product that they could be doing so much more. It's like, oh, I have one of these whole lives. And you look at this and it's like, well, why haven't you done something with it? Why haven't you? I always joke, I go, if I walked into your house, Gary, and there were 3 kitchen tables and 2 dining room chairs, we'd all look at this and go, well, this is crazy. Well, when I review sometimes, or one of our coaches review a client's insurance portfolio, we see 3 kitchen tables and 1 dining room chair. And it's like, man, like, what were you doing? And it's like, well, that's what the guy was selling, right? The guy that shows up at your door every couple of years was selling that. So what I would say is, you've got to deal with someone who specializes in this. So at Control and Compound, this is all we do. Mm-hmm. We're not going to sell you an RSP, a disability, a group insurance, and a pension. We're not going to do all that because we call our wealth coaches like brain surgeons. This is all we do. We do it every single day. So number one, we're going to design the policy the right way. But I think even more importantly, we're going to be there with you in 6, 12, 18 months when you say, hey, I'm thinking of buying this piece of real estate. Does it make sense? to use this policy, and how would that work, and how should I pay it back? We track the loans, we track the repayment, we do coaching calls on no, this isn't the right time, this is the right time. So you can have the greatest policy in the world, but unless you know how to utilize it. So that's why we call ourselves financial educators first and foremost. We won't, if someone calls up and says, sign me up, we won't take them as clients. We require them to have at least a couple education sessions with one of our wealth coaches where we go, this is how it works. Here's the downsides. Here's the upsides. This is what it should be. What happens if you lose your job? What happens if business goes south? What are the get out of jail free cards down the road? Versus a lot of people that are general financial advisors go, oh yeah, I can do that too. And it probably won't be set up properly, and it definitely won't be utilized to the full capacity of what the program can do.
So no, that's good advice, right? Because it's like, oh, you're my mortgage agent? Yeah, but I can also help you buy a home, a real estate agent as well too. Oh, I also do insurance.
Yeah, exactly.
Oh, and I'm a home inspector. Right? So yeah, you want somebody who specializes in it, right? Because things change. And so you're probably up to date. Like, how often are things changing in this realm, or they don't often?
The concept doesn't change a lot, but the ins and outs of it change constantly, right? Like what insurance company came up with a new product? What are the dividend rates? Like, I like to geek out on like the 4 different companies. What are their whole life funds invested in? Mm-hmm. And argue, well, listen, long term, we think this one's going to be better for this. And people get hung up on whether the dividend's 6.5 or 6.35 today, and it's like you're not looking long term, and this is a long term thing. So you look at stuff like that. As far as when the government kind of looks at this, typically every 20, 25 years has kind of been when the government comes in and says, okay, we're going to look at the insurance industry. The last one we had was under our current prime minister in 2017. They came in, they made a bunch of changes. And what they did is they got rid of, not the whole life, but some of the insurance products that were just set up for pure tax. There was no justification other than that. But they actually made the whole life better in 2017. We're actually able to put more money in because, again, if you think of it from a government perspective, well, first of all, we're one of the largest employers in Canada, the insurance industry. But second of all, we're allowing people to provide, we're focused on this cash value, but it's also providing a death benefit to families. So, there's billions of dollars out there that are going to be paid to clients of ours through the years that, eventually, maybe not you, Gary, but everyone else I know, they're going to die someday. And when they die, what happens? Well, we're going to arrive with a big tax-free death benefit. So government really, encourages, almost like we always say, the Income Tax Act is a roadmap that you just got to follow to take advantage of opportunities. And it's real clear in the Income Tax Act that this grows tax-free, you can access it tax-free, and the death benefit is tax-free. This isn't a gray issue. This has been around 100 plus years.
All right. Now let's touch on that family that has 3 different dining room tables and a chair. How do you untangle that for them? Can you, or can you use one of the policies that they have and kind of start mapping them down and moving them down the right direction?
Yeah, absolutely. So we call it an insurance audit. So one of the first things we'll do at the first meeting with our first education session, we call it, what policies do you have now? Can we use one of those? So often, no, I shouldn't say often, sometimes we can use your existing policies and say, hey, did you know that you can access 90% of this? Did you know that you can do this with the policy? Did you know, all these benefits that you didn't know you had? And then not just that, but we'll look at the other stuff to say, okay, well, maybe your term insurance, like, this isn't the right product for you, or this isn't the right term insurance. You have too much term and not enough whole life, or you have too much whole life and not enough term. Yeah. So that's absolutely what we do at the first education session. Go through your existing policies and say, can we use something there? Like just something simple. I'll give you an example. Term insurance, we absolutely use term insurance, because if someone comes to us and says, we want an infinite banking type we want the infinite banking concept, and we design a policy, and the death benefit is not enough to cover all the final or all the needs of the family if something were to happen. Great, we'll slap some term insurance on there, but just who you put that term insurance with, which carrier, is so important. Like for instance, one of the things of term insurance in Canada with all insurance companies is it's guaranteed renewable, which is a bit of a scam because they renew it at some crazy high number, but it is guaranteed renewable if you're uninsurable. But it's also guaranteed convertible, which means if you have a $500,000 term insurance contract, you can actually go to that company and say, I would like to turn it into a permanent insurance product, universal life or whole life, with no medical evidence. So that's huge, right? So down the road, if something changes in your health, you can still take permanent insurance. But if there's only 4 companies out of the 10,000 insurance products, or a couple hundred insurance companies, there's only 4 companies that offer the good stuff, this participating whole life. Well, we want to make sure your term insurance is with one of those carriers. So if something were to happen in your health where you couldn't qualify, and 5, 6, 7 years down the road, you go, okay, listen, financially, I'm at a point now, I want to do this, or I want to do a second, third, or fourth policy. We have the existing policy that we can convert, no medical questions asked. So that's kind of part of the insurance audit we go through.
Okay. Now, is there like an optimal amount that you'd want to put into something like this? And then does there come a point in time where it doesn't make sense to put any more money in? Like, I assume it's something that you put in every year, 20,000, 50,000, whatever the amount is. And then you're like, okay, we're done. We don't need to put any more in because it's now paying enough dividends to satisfy your lifestyle.
Yep. Your money has to reside somewhere. My belief is you might as well have it reside in your own bank. So we've got people that would put millions of dollars into here. We've got people put $500 a month, $1,000 a month, and everything in between. I currently have 9 policies, put multiple 6 figures into this year, because if I'm sitting on cash, what am I going to do with it? It's got to be put somewhere. Am I going to put it with another bank and have it in a savings account? No, I want to put it in the policy. So there's really not too much you can put in within reason. What I don't like is people putting 100% of their money or all their money in here. Like, it's great for a portion of your money, but as your income and as your wealth grows, we have clients always adding more and more policies because your money needs to reside somewhere. And if you think of this from the retirement standpoint, so how do we use this in retirement? So let's say, you retire and you're a business owner at 60 or 65, 70, whatever the number is. And let's just say you have $1 million of cash value. Okay. Well, if you have $1 million of cash value, your death benefit's probably $1.5 or $2 million anyway. So you're like, okay, Darren, listen, this was great. I took advantage of 6 or 7 opportunities that I never would have taken advantage of. I grew my family's wealth considerably because of that, but I don't want to do any more deals. I'm 70 years old. Like, what do I do with this? Well, now we can take those tax-free loans and just use them for lifestyle. So let's take $100,000 out a year, for instance. That $100,000 loan doesn't show up on a tax return, doesn't affect your government benefits, depends what province you live in. If your income affects your long-term care or your government health plan, like OHIP, all these are going to, if they're not income tested in your province now, they will be income tested down the road. Doesn't show up in your tax return. So let's play that example out.
That's brilliant. So I can just shift that money from my PREC, put it into my life insurance, and now I have a lifestyle where I'm not getting taxed on.
Absolutely. So both on the corporate or personal, you can borrow this money personally. Now, again, you got to be dealing with someone who knows all the ins and outs of that.
Right.
But to play that example out, so let's say I've borrowed $100,000 for 10 years. I'm not paying the interest. Well, I've borrowed $1 million now. But I had $1 million when I say at 70, when I start drawing, or 60, that $1 million cash value is probably going to be worth two point some million dollars now, because the full million is still growing completely tax-free. We haven't touched the cash value. We borrowed against the cash value, not from the cash value. So now 10 years down the road, I owe $1 million plus interest, but I can continue to take $100,000 because my cash value continues to grow each and every year. So then I die 15 years in, I owe $1.5 million plus interest, call it $1.8 million. And it's like, you die owing $1.8 million? Well, if the insurance company death benefit, or the death benefit is now grown to $3.5 or $4 million, who cares? So now $3 million gets paid minus the 1.8 outstanding loan. Your family gets $1.2 million.
So as you're borrowing that money and every month you have an interest payment, you don't have to make a payment on that interest?
No.
Crazy.
Yeah. So again,
right.
we want you to in the early years, right? If you're 30, 40 years old and you borrow money now and you never pay it back, well, that's going to be an interest snowball, right? It's going to get, but if you, in the working years, really, we say, borrow it with a plan to pay it back, borrow it to pay it back, right? Like, I do all kinds of real estate where I put the money in. I just did a couple of GPLPs where I put the money in, and we're gonna refinance, and I pay the loan off, increase that. But in retirement, you can borrow that money and never pay it back. You could earlier,
Right.
but retirement, you don't make a plan to pay it back.
Because essentially what you're saying is, if I got this concept right, is that the snowball over here is bigger than the snowball over here. So this is the interest payment, and this is what's been invested, and it's bigger than this one, so you don't have to ever worry about it. Is that essentially what it is?
So let's play that out. So if you get a $100,000 loan and you get $1 million cash value in your retirement, where your loan, call it 6%, is going to grow, what's that, $6,000? Well, your cash value is going to grow $50,000 or $60,000.
Right.
So your loan's not going to catch it. And that's why they use that kind of 90% rule. The idea being your loan shouldn't catch your cash value, because your cash value will grow faster than your loan interest.
Got it. And that's what you talked about at the beginning, saying when you get to retirement, you don't have to even pay it back.
Yeah. And that's just one strategy in retirement. Like, again, people typically, they come in their 30s, 40s, and 50s, and, like, one of the misconceptions is, oh, I'm too old for this. And I could show you an illustration for a 50-year-old or a 30-year-old. And in traditional insurance, it's pretty simple, right? A 50-year-old is going to pay way more for the premium for the insurance than a 30-year-old. Mm-hmm. But the way we design this, where we're focused on the cash value, a 50-year-old in 10 years would have roughly the same cash value as a 30-year-old in 10 years with these policies. So you're not too old. So it doesn't really matter when you start. If you start when you're 65 or 70, you're kind of pushing it there. But that's the key, is we can play with the death benefit. So the 50-year-old might get less death benefit than the 30-year-old, but their cash value is going to be roughly the same.
Right. And then the good thing, okay, so a couple more questions here. So then what about first to die, or is it both to die? Like, how does that piece work? Does it matter?
Yeah. I encourage people to look at single life policies. Joint last to die, joint first to die is a windfall for the insurance companies, because they're only paying one death benefit. Like I talked about borrowing the cash value. That's just one of the strategies in my Be the Bank book. I talk about 5 different strategies, but there's probably 10 different strategies. People don't care about the death benefit. A lot of people don't care starting out. Some people are concerned for their family, but a lot of people, the death benefit. But you hit someone in retirement, all of a sudden that death benefit becomes real important. So to your point of single or joint last to die, my wife and I both have a bunch of these policies. We get all kinds of cash value. We get all kinds of death benefit. One of my strategies in retirement is I will refinance the heck out of my income properties, take all that refinance tax-free money, spend that completely tax-free. Or let's say, people in Ontario here, they're sitting on a house worth $1.5 million today. Well, you play that out for the next 30 years. Their house is worth $3 or $4 million. Well, you don't think of going to get a mortgage on your house when you're 70 years old. But if you know now you have a $5 million death benefit when you die, why don't you go take a $100,000 line of credit per year on your house, spend that money tax-free, die owing $1.5 million there? Well, there's a $5 million death benefit. You sell your business and you say, great, I can spend that money I sold my business down over the next 15 years. And if I die, my family's going to be fine because there's millions of dollars of death benefit. So there's lots of strategies to spend it in retirement. So we basically, the wealth coach will determine in your retirement, what's the most tax efficient way? How do we get tax-free money into your hands so you don't have to pay any tax on the money, whether it be refinancing, loans against the cash value, et cetera.
Right. All right. Whew. There's a lot.
There's a lot.
There's a lot. Yeah. You know what? You've also helped me connect a few more dots, because I've been in this now for about a year. But every time I hear you talk, or I listen to something a little bit more in infinite banking, I'm like, okay, I didn't understand that piece there, right? So it's always good when I have that light bulb moment, which is good. Anything else that we should touch on before we kind of wrap things up that you really want to hammer home? Yeah,
I think just one thing on what are the downsides, and I think that's important for people to people like the line we hear the most is, this is too good to be true. Why isn't everybody doing it? And it's not too good to be true. It's been around forever and ever and ever. The reason you don't hear about it is the banks, the mutual fund company, the banks can't sell this, right? They can't sell life insurance at the branch level. So they're not looking to give you control of your money. They want to be in control of your money. Okay. So,
Meaning,
meaning,
give us money and we'll put in an RSP for you. So
well, think of the strategy of a bank. What they want to take your money systematically, put your paycheck in there every 2 weeks. They want to keep that money for as long as possible, like an RSP, and then they want to drip that money back to you as slow as possible. Think of RIF when your RSP turns into an income producing. So you could be 20 years old and they could have your money for 80 years. So they want access to your money because what do banks do with money? Well, they take it and they multiply it and they loan it out. I put $100 in the bank account and they loan it to someone else and they charge that person interest for loaning my money out. Well, I want to be that bank, and that's why my book's called Be the Bank. So that's what the banks are doing. So you got to be careful on that. And the second thing is a lot of these policies, when they're designed poorly, you're in a lot of trouble if you can't continue to pay the premiums. So I've seen policies that really have no cash value for the first 5 years. Now, it's not a policy that we would ever sell. But what happens is year 2, 3, 4, all of a sudden something goes south, and that person, those are the horror stories you hear. Oh, they paid all this money and they got nothing back. None of our policies are going to be designed like that. We'll design a policy typically that if you make the first 2 years a premium and something happens in your business or your real estate, you could take like 5 years off of making a premium payment and you're fine. So the importance of loading that cash up as high as possible, which goes back to dealing with an expert. So that would be sort of just a cautionary tale of, dealing with someone that doesn't specialize in this. You can just get a policy designed poorly, and really there's no flexibility built in that. Because we're dealing with business owners and real estate investors, flexibility is our probably number one thing we want to focus on.
Yeah, for sure. You know what? I thought I was going to wrap it up, but I have one more question.
Sure.
RSPs. I've got money in my RSPs. I got money in my pension. Should I move that into this? How does that? Because obviously I'm going to get hit now on the taxes. Does that make sense, or do you leave it there?
Yeah. So I'd never encourage anyone to cash out all their RSPs and put it in a cash value life insurance policy, because you're going to pay a boatload of tax on that. If you're a business owner, real estate investor with a PREC, sometimes there's opportunities there. Like, we've got lots of people that will say, okay, I'm going to no longer take 40 years old. I've got a couple $100,000 in my RSPs. I realize now that money's effectively in prison, right? That money I'm not going to be able to really touch for opportunities forever, or at least for 25 years without paying a boatload of tax. So sometimes business owners will say, okay, why don't I stop taking an income from the business? And let's just use $100,000 in my example. I'll stop taking that $100,000 income, and I'll leave that in the corp and have $88,000 to invest, right?
Right.
Perhaps or put in a policy or real estate or both. And then in order to live, now I'm going to start taking my RSPs out today, and maybe I can, take out 50, 60, some reasonable amount that you're not going to get hammered at taxes. Because I always ask someone, I go, so let me get this straight. Your financial advisor came to you as a 30 or 40-year-old and said, tell you what kind of rock star investor I am. If you invest your RSPs with me every year, when you're retired, I'm going to make you poorer than you are today, and you're going to be in a lower tax bracket. And most of the people that get there realize they're not in a lower tax bracket. So that's really an RSP. It's not a tax deduction, it's a tax deferral. You're deferring tax to a later point. And I think most people, especially people that are successful, they're deferring a lower tax to a higher tax environment down the road. So if there's an opportunity to maybe leave more money in your business, take advantage of these type of policies and spend your RSPs down, or if someone takes a year off with a child, well, that's a great time to start accessing some of your RSP money. Again, after talking to an advisor and getting all kinds of good advice, but because then, you're in a 0% tax bracket. You're never going to be in a lower tax bracket. You're not going to be in a 0% tax bracket when you hit retirement if you are successful and you've accumulated wealth. So if there's an opportunity to get money out in a low tax environment, I say take it.
Right. Darren, thank you very much for your time. Great advice. And I think really what you hammered home is the importance of finding a good financial advisor to guide you through this. Whether you have your RSPs, whether you do have a life insurance that you currently have, maybe just turning that Ferrari on. Maybe you got a Ferrari, you don't even know it's a Ferrari yet,
Yeah.
right? But having somebody that can help guide you down the path that you really want to go down, and somebody who is where you want to be. And I think that's what is always the most important thing is get the advice from people that are where you want to be, as opposed to your coworker sitting beside you.
Yeah, absolutely, absolutely. Like, it's like I remember years ago talking to this guy back when I was a traditional financial planner. I was a wealthy guy, and I'm like, "Oh, you should have a group RSP, and then you can do this." And he just kind of looks at me. He goes, "You want me to put my money in a government program?" He goes, "That's not how I got wealthy."
Yeah.
And I was like, "Oh man, this guy doesn't understand." I left the office when I was like 30 years old. Go, this guy doesn't understand the importance of RSPs, and I'm like shaking my head, going, "I was poor and he was super wealthy," and I'm thinking he doesn't understand. And now it's like, yeah.
Yeah. So Darren, listen, if anybody wants to learn more about you, get in contact with you, how can they do that?
Yeah, so controlandcompound.com is a great resource. We've got all our stuff there. We've got the books. We've got free webinars on there. We have a podcast, Control and Compound.
Great podcast, by the way.
Thank you. So there's 150, 160 episodes. We'll put a link in the show notes. If you're a listener of Real Talk with Gary, we'll actually give you VIP treatment, and we'll set you up with an education call with our client, with one of our wealth coaches anywhere in Canada. We use Zoom for this. It's not a sales pitch. It's an education. We won't sell you. We will educate you. And if it's something you want to learn more about, we'll continue the education.
Awesome. Darren, thank you so much for your time. I appreciate it. And you gave me some light bulb moments today. So that's what it's always about. So I appreciate it.
Thank you so much for your time.
All right. Take care.